Today we're going to look at the differences between long-term stock investing versus short-term. And you might be surprised to hear that the main differences comes down to why you're buying the stock in the first place. Because you would think that both investors, short or long-term, would be buying for the same reason, to make a profit. And of course that is ultimately the goal for both, but when you look a little closer, you discover there's actually a huge difference. So we're going to talk about those differences, and by the end of this video, you're going to know exactly which one is best for you. Alright, so for this video, let's consider short-term investing to be anything that has the goal of making quick profits. Whether that's in the matter of a couple minutes, hours, days, weeks, or even within a couple of months, would all be considered short term. So let's start here. In short-term investing, although there are some exceptions, for the most part, the focus is on what the share price is going to do in the near future. And since share prices are set by the people doing the buying and selling, and the current price of any stock is just whatever it last traded for, ultimately, these short-term investors are focused more than anything on predicting what other people are going to do. So a short-term investor might look at something called a candlestick chart. And often these candlestick charts have a bunch of other technical indicators added onto the chart as well. And so they will look at this chart and the different indicators, and they will try to predict what the price action will do next. Which of course is just another way of saying they're trying to predict what other people are most likely to do next. For example, a short-term investor might have a strategy where they wait for moving averages to cross over each other and use that as a signal to either buy or sell. Some short-term investors will get even more sophisticated with it and have multiple indicators that they use to get their signals. But again, ultimately what they're doing is just predicting future price action, which again means predicting what other people are likely to do. Now, another thing that short-term investors do is they focus on the news. For example, if a news article comes out that is very enthusiastic and favorable about a particular stock, then short-term investors might race to be the first one to buy it, with the thought that others will soon be buying it as well, which will drive up the price and make their little trade profitable. As other people start buying it up, the price will go up, and then of course these short-term investors also attempt to be the first one to sell as well, so that they can collect the profits before the sell-off that happens from everyone else trying to collect profits. Does that make sense? There's actually a guy, you've probably heard of him, named Jim Cramer, that has a show on CNBC called Mad Money. And research has shown that anytime he mentions a stock in a favorable way, that stock has shown to increase by an average of 3% in the short term following his mention. And this little phenomenon has been coined the Cramer bounce effect, and it's caused by people simply just buying the stocks that he mentions, and because enough people are doing exactly that, it causes the price to go up. And yet another way short-term investors may also choose to buy stocks is simply just buying stocks that have recently jumped up in price. And they're doing this in anticipation that it will continue to increase. Now, this is often referred to as momentum investing or momentum trading. So these are some of the main ways that people go about making short-term investing decisions, but there are definitely even more ridiculous ways out there as well, including some people even use astrology and the positioning of the stars and the planets in the night sky to predict what the stock market will do. Now, regardless of what the method is of making these predictions of what the price will do, if enough people are looking at that same thing, thinking and predicting the same thing about what the price will do, then the market can end up sometimes really just being one big self-fulfilling prophecy, one after the other. Can you see how that would work? And so there's a couple major downsides to investing like this. For one thing, knowing when to sell and take your profits can be very difficult, because on one hand, you might be thinking that you need to sell fairly quickly when you do see a profit so that you can capture that profit before the stock goes down and turns it into a loss. But on the other hand, you wouldn't want to take your profits too early, because you will have some losing trades and you want your winners to more than make up for your losers, right? Because if you're only making small profits on your winners, but taking much larger losses on your losers, then you're just gonna end up burning through your money. And knowing when to sell when you have a losing trade on your hands is just as difficult, because you could easily find yourself down a bit on your trade before it subsequently goes back up. And if you were to sell too quickly, then you can end up losing money on a trade that would have otherwise been successful if you had just held on and give it a bit of time to play itself out. Sounds tricky, right? So ultimately, short-term investing really shouldn't actually be called investing at all. And the real name for it, what we just described, is actually something called speculating. Now, an easy way to know the difference is this. If you're focusing on what the price is going to do, you're speculating. So what is the alternative? If all of what I just described is considered speculating, what does it actually mean to be truly investing? The big misconception is that it has to do with time horizon. Now, just because your intended holding period is long term doesn't actually make you an investor by default. Now, to answer this question, we have to recap the often forgotten fundamentals of stock investing. Now, for some of you watching, this will be a total repeat. You've heard me say it a million times, but for some of you watching, this will be new and this will be a total game changer. So owning shares of stock means that you own a percentage of the company. So literally, if you own 1% of the shares outstanding of a company, it means that you own 1% of that company. And so if the speculator is focused on the price, the investor is focused on the company. But it's not enough to just identify a great company that you think will do well and then just buy it with the intention of holding it long term. That's not enough. There's a lot of companies that I think are amazing, great companies, but I've never bought any shares in them because they've never been good investments. And this is because a lot of these great companies trade at prices that are too high to make them a good investment. See, stock investors, unlike speculators, are focused on the business and its true value. And they only look at price to see if it's an attractive price relative to the true value. And true value is based on the future cash generating abilities of the company in question. So for example, imagine this. If you were to be buying a private business in its entirety in a negotiated transaction between you and a seller, the price that you would be willing to pay for it would largely be based on your expectations of that business's future cash generating abilities. Am I right? And the price the seller would be willing to sell you the business for would also be based on the same thing, right? The seller wants to get a fair price too. And if you buy that business and pay way too much for it, it would be a bad investment. If, on the other hand, you buy that business but at a bargain price, then it would be a great investment. That makes sense, right? Same thing with a rental property. If you're buying a property as an investment property, you can pay a price that's way too high to make it a sensible and good investment. But you can also get the property for such a low price that even if the property is not that great, it can still be an incredible investment. So public companies are no different than private companies just because the ownership of them has been divided up amongst millions or billions of shares. It's no different. In fact, the fair value of one single share is just whatever the fair value of the entire company is divided by the number of shares outstanding. Does that make sense? So investors are focused on the business and its value. That's important. And investors actually exploit the fact that the stock market can sometimes price stocks below their true value and actually take advantage of those opportunities. That's what Warren Buffett has done, and that's what every other successful investor with long track records of success are doing. Now, what is especially cool about the stock market is that sometimes the market, which again is just the people doing the buying and selling, can sometimes price stocks so irrationally low that you can be presented with opportunities to buy your fractional ownership at prices that would never be available in a negotiated transaction. That's pretty cool, right? So a short-term investor, which we've renamed as a speculator, can actually have a short-term time horizon or a long-term time horizon and still be a speculator. And a long-term investor, which we've just renamed as just simply an investor, can also have either a short-term or a long-term time horizon. Time horizon is not what matters. It's what the focus is on. Again, speculators are focusing on price and investors are focusing on the value. Now, right now, you might be asking yourself, how is it possible that the market could price stocks at extremely discounted prices like what we've just described? And the answer to that question is the focus of chapter 8 of the book, The Intelligent Investor, which is what Warren Buffett says is the most important chapter of the most important book for anyone to read who is serious about stock investing intelligently and rationally. Now, I don't actually typically recommend that if you're new to stock investing that you read this book, because it was written quite a while ago and it's actually pretty dense, and it's really not that easy of a read, especially if you're not used to reading a lot. However, I cover this chapter in this free long-term investing masterclass course covering everything that I wish I knew when I was starting out. And also, as a quick disclaimer, I'm not your financial advisor and my content is not financial advice. So click here right now and I'll see you over there.